name's Mark Reichman. I'm a senior research analyst at Noble, and it's my pleasure to introduce Terry Marshall, who's the senior vice president and chief financial officer of Alliance Resource Partners. And we're going to take kind of a conversational format this morning, I guess a fireside chat absent the fireside. And so I'm just going to start out by, and we'll have time for Q&A at the end. But Carrie, it might be helpful if you could begin by just explaining Alliance Resource Partners structure as a master limited partnership, and also just provide a snapshot of its various businesses.
Sure, Mark, I'd be glad to do that. First off, before I get into it, I just want to thank you, Mark, and the folks here at Noble for hosting us again and inviting us to the conference here. We presented for a number of years here. It's great to be able to be here and be able to share our story with you all. Here at Alliance, we've got a long history as a publicly traded company. We're celebrating our 25th year as a publicly traded company today here as a part of NASDAQ. So thank you, Mark, for allowing us to be here again this year. So I think first part of your question gets into our tax structure. So from a structure standpoint, we are structured, as Mark mentioned, as a master limited partnership. So we get lots of questions about what is an MLP. And simply put, MLPs are tax advantaged, yield oriented, publicly traded vehicles that were formed to invest in qualifying businesses. These qualifying businesses typically related to energy infrastructure, typically related to natural resource related activities overall. They are classified as a partnership for federal income tax purposes, so they are pass-through entities. So generally speaking, at the entity level, we don't pay any income tax. Instead, our unit holders report their proportionate share of our annual income on their individual income tax returns via a K-1 filing that we provide out to our unit holders each and every year. So the distributions that we pay are actually only taxed once versus, say, a typical C-Corp structure. Whenever they pay dividends, those actually get taxed twice, once at the entity level and then again at the individual investor level when the dividends are paid out to the individual investors. From an individual perspective, there's also a few other tax advantages to the structure. The cash distributions that we actually pay out of this structure are to a large extent treated as a non-taxable return of capital when those distributions are made, as long as our tax basis is above zero. So when an investor sells an MLP unit, the tax will become due at that particular point in time based upon what they're selling it at during that time versus their adjusted basis. So the distributions paid actually reduce your basis. So you get them on a tax deferred basis in terms of your distributions. And finally, if individual unit holders, if they hold our units until, or MLP units until they pass away and pass them on to their heirs, those units do receive a stepped up basis at that particular point in time. So any distributions that have been made to that particular point in time are not taxed. So there are several benefits to the tax structure of a master limited partnership. Obviously, we're not tax advisors, so everybody's situation's kind of on their own. So you have to talk to your own individual tax advisor as it relates to that. But in a nutshell, that's the MLP structure. I think the second part of your question got into just a little bit about Alliance and kind of a snapshot of our business. Alliance today, we're a leading energy company. Today we have been in operations almost 3 decades. Today our overall market cap is $3.6 billion. And essentially, we have 3 lines of businesses today. Our largest part of our business is our legacy coal business. Generates approximately 80% of our profitability, our cash flow. It's been a generally consistent business for us over time. We are the largest producer coal producer in the eastern United States. We operate currently 7 underground mining complexes, serving primarily major domestic and international electric power generating companies throughout the U.S. and actually internationally as well. We also have a growing second line of business, which is the growing mineral royalties portfolio that we have today. This part of our business, we actually invest in strategic oil and gas producing regions throughout the United States. And in addition to that, we also have strategic coal reserves in the basins in which we operate that we generate royalty income from as well. So that part of our business today is around 20% of our business. Good cash flow generating business for us as well. And then the final part of our business, it's more of a developmental part of our business. It's our third platform. It's our Matrix and New Ventures group. It's really Matrix is kind of the primary investment vehicle that we have here. It's an energy technology group and company that we're making investments in, provides safety and productivity solutions to the mining and industrial sectors.
You know, Kerry, what impact do you think the incoming Trump administration will have on energy policy, and what are the ramifications for the electric power industry and also the coal industry?
Well, I think, with the incoming Trump administration coming in, Mark, I know you put out a note on us here recently, provided some summaries. I thought you summarized it well. With the new administration coming in, we would expect fossil fuel industries to benefit from the new administration coming in. We do think the business climate will be much better with more market-based type energy policies out there, less regulatory burden on a going forward basis. We do think the Trump administration will look to roll back some of the recent EPA regulations that have been announced, particularly around some of the climate initiatives that are out there. And so for us, with the largest part of our business supplying coal-fired power plants, we do feel like that benefits our business, benefits the life of existing coal-fired power plants on a going forward basis, gives them much longer life than we feel like the market has appreciated historically and what they're thinking now. We also think the Trump administration will look to roll back some of the subsidies provided to the renewable sector through the Inflation Reduction Act as well. I think one of the other things I think it's important to point out, I mean, we are realistic in our expectations on this, Mark. I think we're not really anticipating any new coal-fired power plants to be built, but we do feel like the new administration coming in and the regulatory, the relief in the regulatory burden will benefit existing coal-fired power plants with longer life, more stable demand, if not, and we're optimistic that demand can be growing to supply some of the data center power needs going forward. So all in all, that should benefit primarily in the markets that we operate in the East, lead to a benefit of Alliance.
Well, and that's what I was going to, the type of coal that you mine and sell and where your mines are located. You've operated a pretty stable coal business over the years. Mm-hmm. We've seen Peabody, acquire coal assets in Australia. Arch and Consol seem to be kind of focused on the overseas market. So could you just talk a little bit about, how you think you might be able to profit and grow market share given a relatively stable outlook for the industry?
Sure, and I'd be glad to do that. I'll just get to this. Kind of gives you a picture of where our existing operations are. So if you look at our legacy coal business, I think it's fair to say in terms of the coal industry outlook, we're very optimistic to the fundamental outlook for coal, particularly in light of the election. So we're excited about what the outlook is. I think one of the things that's important to point out first and foremost is that we have been committed to the coal business and believed in the coal sector for a number of years. Even when others were questioning the long-term outlook of the sector, we believed we had many years to come of generating strong cash flows for our business, our coal business that we operate today. We have been strong in that belief, and we've invested significantly in our operations over the last couple of years, just to ensure that those operations are as low cost as they can be on a going forward basis. So today, when you look at our operations here, we've got 70%, 75% of our operations in the Illinois basin, the other 25% in Appalachia. We are a low-cost coal producer. We've got unique access to both the domestic and the export markets. We've got a proven track record of generating cash flows throughout any business cycle. So we've gone back, a long time to be able to do that. And, I think one of the important things to note too is that we're poised to benefit from the expected increase in U.S. electricity demand coming as a result of data centers coming online, onshoring of U.S. manufacturing, generally speaking, just the AI revolution overall, really benefiting the areas that we operate in throughout the eastern United States. And I think, additionally, one of the important things to point out about the coal business is that the coal business is as much about relationships and reliability as anything else. We have longstanding relationships with major customers, major electric power companies like AP, Duke Energy, Louisville Gas and Electric, Tennessee Valley Authority, all major customers of ours have been for decades. And for our customers, reliability, dependability, long-term commitment to the business is just as important as price as anything else. All these factor into their long-term decisions to do business with us. We entered into a contract this past quarter that carried us into 2030. Generally speaking, going into any year, most contracts are 1 to 3 years. Generally speaking, going into any year, it'll be something along the neighborhood of 80 to 90% committed at that particular point in time. Gives us a good base of cash flow as we project the year going forward.
You also have a growing portfolio of oil and gas royalty interests. So could you talk a little bit about how that business has evolved and kind of your expectations going forward?
Yeah, I think the oil and gas business, it's an interesting business for us. It's one that we're really excited about. It's one that we really like the business that we're building within our oil and gas minerals portfolio. If you look at this, we began investing in oil and gas minerals a decade ago. And originally we had made our original investments there in a passive way, smaller scale, just to try and understand the business a little bit more. And as I mentioned, we did it in a fund, in a passive way that was designed to acquire oil and gas mineral interests. If you look at the first 5 years of how we participated in this business, that's the way we did it. But in 2019, we made the strategic decision that we wanted to become more active and more involved in the oil and gas minerals business. We liked the cash flow that we were generating over the first 5 years. So in 2019, we made 2 large minerals acquisitions in that period of time. We also hired a dedicated management team that's in place today that is actively managing and acquiring oil and gas properties today. If you look at our oil and gas minerals business today, we generated about $40 million in EBITDA in 2020. This year we'll do about $115 to $120 million or so in EBITDA. We have a strong position in the Permian Basin, which is the highest growth region in the U.S. in terms of oil production overall. Now, mind you, we're not an operator. We just collect royalties. So many of those royalties come from major operators like Exxon, Diamondback, Occidental, We just collect those royalty payments from them. These particular types of entities tend to drill through business cycles. But this is a business, as I mentioned, we really like it. We're looking to continue to grow it. We generally will take the cash flow that we generate from this business, reinvest it in this business, and that's the result that you see here in terms of what the volumes are. So I think if we're able to execute on this plan, you look 8 years down the road, this particular chart here, it's very reasonable to sit there and think that those volumes are going to be double where they are today.
And you might want to talk a little bit about some of the investment that Alliance has made outside its traditional businesses, including coal and oil and gas.
Oh, sure. Yeah, we actually do have, much like how we got in the oil and gas business a couple years ago, we're looking to diversify our businesses again, just to become a little bit more diversified, in a few other different areas. I wouldn't say these are big investments that we made, over the past couple of years, and part of them are kind of taking smaller bets to see whether we can find businesses, much like what we did in the oil and gas business, that we can become more active on down the road. We'll see. There's still a little bit to go on that, but we actually invest in Bitcoin mining. So we have been doing some Bitcoin mining since 2001. It's more of an opportunistic type investment for us. We
2001
or 2021, excuse me. So 2021. So we started making investments in that today. We hold about 40 million, a little bit over 40 million of Bitcoin on our balance sheet today. But I think, the primary vehicle that we use to invest in is through our Matrix subsidiary, which is the energy technology company. That company does that through proximity detection technology that benefits the mining sector, as well as collision avoidance technology that benefits the industrial
Right.
sector.
You've talked about it in terms of businesses that you'll own and operate, or you acquire the interest in Infinitum, which has now a collaboration with Matrix.
That's right.
And then there's some other investments that you've made that kind of gets you exposure to a sector that you may elect to build on or not, going forward. I want to just give you a little opportunity to talk about the capital allocation process, and also, what you think investors sometimes overlook, or miss when considering Alliance Resource Partners' value proposition.
Well, sure. I think when investors look at Alliance, I think one of the things that they often overlook is the fact that we really are more than a coal company today. I think when you look at Alliance, we do have these other lines of businesses, and so I think when you look at the valuation that the market places on us as a coal company, typically coal companies will have lower multiples. We've never agreed with the multiples that they place on the coal companies, because we think there's a much longer life than what the market appreciates. But some of these other lines of businesses, like the oil and gas minerals business, many times trade, if you look at the publicly traded peers, they'll trade at twice the multiples as to what the coal companies trade at. And so when we look at the valuations, it appears that the valuations are putting it all together and valuing it more as a coal company, even though we have this growing portfolio of oil and gas minerals. And so we just feel like that's a good value proposition for individual investors in terms of what they overlook. In terms of capital allocation, I think, when you think about capital allocation, it's one of the most important things that businesses do today. We're very focused on it. I think the first thing that I would point out is that as you look at our capital allocation philosophy, I think it's important to point out that we do manage this business for the long term. All of our management team is significant owners in the company today, so that when we manage the business, we tend to be a little bit conservative in nature, but we want to be sure, first and foremost, that we have a strong balance sheet. If you look at our balance sheet today, you'll see that our balance sheet, we have very low leverage. If you look at last quarter's debt to trailing 12 months EBITDA was 0.6 times. 0.4 times on a net basis. If you look back to 2021, It's been under 1 times on a net basis since that period of time. So strong balance sheet, is the first thing that we look at. Second thing that we focus on is our coal business, largest part of our business. We want to be sure that the coal business has plenty of capital allocated to them to be able to ensure that they're going to be the lowest cost that they can be and most successful going forward. By way of example, if you look in 2024, we're at the tail end of a 2-year, fairly significant investment process that will start realizing benefits through lower costs going forward this year. So we're investing somewhere between $420, $460 million in our coal business this year. Typically, we'll invest $250 to $275 million on a maintenance basis, but these investments that we've made will allow us to be lower cost on a going forward basis and benefit us.
And you'll have
per year.
you'll have a lower CapEx.
That's right. You'll have lower CapEx as well. The third thing is our minerals portfolio in terms of capital allocation. As I mentioned earlier, we do focus on this business and intend to grow this business more into the future. And we'll take that cash flow, reinvest that cash flow during that period of time back into this business. And finally, as I mentioned, we are an MOP. We are a yield-oriented type of vehicle that's out there. So paying out distributions that are earned to our unit holders is a very important final aspect we look at as we allocate capital. That cash flow primarily comes from our coal operations. As I mentioned before, it's an important part of what the board does in terms of paying out to our unit holders. So they look at it on a quarterly basis. They look at distribution coverage. They focus on capital needs of the business, distribution yield, debt service costs, things of that nature. Distribution coverage is a big one that they focus on each quarter, and they'll make the decisions as they deem appropriate there. So we take it serious, and it's one that we look to allocate that capital in a responsible manner.
I wanted to give the audience an opportunity to ask some questions too. So I know you were.
You have 3, I'm sorry.
Yeah.
Oh, yeah, so could you provide a review of what has transpired in recent years or even decades to make the use of coal cleaner? So the technologies that have been employed in the industry, what is left to be done, forgetting about carbon dioxide, don't go there. Things like radiation. I think there's been technology for years to take things out of the effluents from chimneys, et cetera, or maybe fuel cells. What's on the horizon to clean it up even further, to make it totally pollutant free.
Yeah.
Well,
Yeah.
Go ahead.
Yeah, I was going to say on the horizon is still more developmental. If you want to make it totally free, it's probably going to get into carbon capture, eventually on down the road.
I don't want to talk about carbon dioxide.
That's the one that's
needed. Yeah.
If you look at who we're shipping into our power plants today, 95% sulfur has always been a big aspect of what's been going on over the last 20, 25 years. Today, 95% of the power plants that we ship into have sulfur dioxide, nitrogen oxide technology put on to capture that out of their smokestacks. So,
with more than 6,000 small and micro cap companies listed, if you're looking for the next Apple, then Channel Check truly is your trade. It's an investor community where you can access independent Wall Street research, advanced market data, balanced news, corporate videos, and podcasts. You can even register to attend in-person Meet the Management Series luncheons, and to be part of the preeminent annual Small and Microcap Investor Conference, NobleCon. And here's the best news. Since Channel Check is sponsored by the featured companies, premium membership requires no investment. It's absolutely free. So check it out. Log in today. Find out why Channel Check is North America's leading source of research on the companies that just may change the world.